Hello, welcome back. So in today's video, I'll be talking about United Healthcare stock as well as your earnings this week. So for reference, this is my portfolio. I have a lot of different companies here, and one notable company that reported earnings today in my entire portfolio list is Corp, and another company that is dropping massively today is United Health. So I'll be talking about United Health first. The stock is currently down around 4%. It is currently trading at an 11 times earnings, giving you around a 3% dividend yield. So why exactly is United Health down? So United Health actually released this. This was in their 8K. So they came out and said that they're proactively reaching out to the Department of Justice after reviewing media reports about investigations into certain aspects of the company's participation in the Medicare program. So the company has now begun complying with formal criminal and civil requests from the department. The company has full confidence in its practices and is committed to working cooperatively with the department throughout this entire process. So what this means is United Health actually voluntarily outreach to the DOJ to try and resolve this entire issue here. So despite the stock dropping down today, I see this as a positive. I mean, the company is doing what it can to clear its name so that it can sue all these media outlets that were trying to basically ruin the company's reputation. So for United Health, if you have to look into the news itself, a lot of your news outlets are actually sensationalizing it. So this is from CNBC. It says, United Healthcare says it is cooperating with DOJ investigations into Medicare billing practices. And if you have to look into the article as well, the entire slant of the article is that United Health is being investigated by the DOJ, and they completely neglected the fact that United Health voluntarily reached out to the DOJ for this investigation. So this is what you always see in the news, and that is why the stock dropped today, around 4%. So for United Health, their earnings are next week. So they'll be reporting their earnings on 29th of July, and they'll be issuing their guidance for this year. So the earnings expectation this quarter is actually down around 30% year on year. So the expectations are quite low for this one. But for a lot of your other different healthcare companies, they're getting hit. Molina Health released their earnings yesterday, and then they reduced their guidance around 10%. Elevance reduced their guidance by around 14%. So for United Health, it is expected that the earnings will come in quite badly. But we have to see how much the guidance changes from the one that they reported the last time. So for the company, besides that, you're seeing a lot of insider buys. I mean, the first time the stock dropped in around May or so, the company CEO, Hemsley, actually bought back a lot of shares. And you're seeing insider buys at record highs as compared to what is seen over the past few years. So for United Health, it is a fundamentally strong company that is facing headwinds in the entire industry. I mean, all the insurance companies are suffering in this situation together. So it is not a United Health specific problem. Of course, the fraud issue could come out in the future, but the company is voluntarily doing so. The stock is down on recycled news. The company is great value at its current price, but you must be aware of the risk associated with a name like this. So although United Health is cheap, cheap can become even cheaper, or cheap can become more expensive if the company's earnings actually drops way more than what the PE has dropped by. So if in this quarter United Health's earnings drop by 30%, then the PE will actually inflate by 30% or so if the stock price remains the same. So all in all, United Health may look cheap now, but in the future it may not look as cheap as it seems if the earnings continue to drop. I'll have to see how this one plays out. For United Health, as well as all your different other insurance companies, they're planning to hike their prices this year. So if they can successfully hike their prices and claim back the margin that they lost over the past few years, then all your insurance companies, they could be deep value buys at their current price. Next portion, I'll be talking about LVMH stock. So LVMH is down around 3% today. It just reported their earnings. So the stock is currently trading at an 18 times earnings, and after the earnings itself, the company is trading at around a 20 times earnings. The dividend yield is around 2.5%. So for LVMH, this is their earnings. So revenues went down by 4%, profits went down by 15%, net profits went down by 22%, operating cash flow went up by 29%, net debt went down by 16%, and equity went up by 1%. So the company is still facing strong headwinds, and the profits are still dropping for this company. So for this company and the individual segments, you're seeing weaknesses across the board. So the only positive in this entire list here is your selective retailing, which is Sephora. Other than that, all the different other segments here are facing negative growth. So you have fashion and leather goods, which is down around 7% in the first half of 2025. Your wines and spirits down another 7% after a record down year last year. So for LVMH, the total revenue is down around 3% this year, and that's why you're seeing the profits coming down by quite a fair bit as well. So for this company, the reason why the company is so weak is because of the weaknesses in your Asia segments. So Asia excluding Japan is still seeing negative 9% growth. Japan is seeing negative 15% growth because of the strengthening yen. And for these two segments, they make up a significant portion of LVMH entire revenue. So unless the China market starts to turn, unless your Japanese yen becomes weaker again, we could continue seeing negative growth for these two segments in the second half of 2025. So for LVMH, it is a company that is in an industry that is facing headwinds, similar to United Health with their healthcare insurance. The entire luxury market is down. So luxury is cyclical and we are currently in a downtrend. LVMH is currently trading at a 20 times earnings. I expect their earnings to drop by quite a fair bit this year as well. So the 20 times earnings might not look as cheap as what it seems. This company's profit, if you're to extrapolate it, will likely drop by around 20% this year. So come year end, at its current stock price today at around $450 a share, it is actually trading at around a 24 times earnings. So I'll be staying out of this one for now. It is a quality business, no doubt, but it is facing strong headwinds right now. I think it is much better for you to wait till there's a point where your earnings start to grow again before you start buying into these kinds of companies. The next stock that I'll be talking about is Corp. So Corp reported their earnings today. At one point, they were up around 7%. Currently, it's up around 1%. The stock is trading at a 30 times earnings and giving a dividend yield of around 1.56%. So for Corp, this is their earnings. So net sales increased by 1%. They achieved gross margins of 30%. Operating income went up by 1.2 million. Diluted EPS for the first time in many years has gone up by 4%. So this company is finally seeing growth again, and they've updated their annual earnings guidance to $10.80 to $11.30. So the company actually lowered their guidance, and that's why the stock sold off during trading hours. And for Corp, this is one of the slower turning companies, a quality company in a niche space. I own a tracker position in this one. I'll look to add if the market gives me opportunities. I think the stock right now is priced about fair value also. I don't think it is extremely cheap. So I'll hold off this name for now. The company could definitely see growth again in the next few years, especially if your interest rate starts to come down. So for Corp, I view this as more of a macro bet. It is a quality business in a segment that is depressed right now, and you will likely see the recovery over the next few years. Next portion, I'll be talking about the best buys in the market right now, in my opinion, of course. So the first stock is actually MSCI. So MSCI today is up around 2% and is currently trading at a 36 times earnings. So I'll be going through a research piece that I've written for MSCI. So this is my MSCI research piece. So it says MSCI was previously under Morgan Stanley and it broke off in 2007 under the MSCI branding. And their current CEO is Henry Fernandez. He's followed them since the Morgan Stanley days. So MSCI operates under a few business models. You have your indexers, you have your analytics, you have ESG and private assets data. So under the index portion, they have a few different types of indexes under it. So you have your country index, your global index, your ESG index, factor index, all the other indexes here. And for this portion of the business, it makes up around 55% of the total revenue. So they use it as a benchmark against performance. They use it to mention their name and performances in their terminals. More importantly, clients pay MSCI to create ETFs, to create institutional products. It's much easier for ETF managers as well as asset managers to get approval by benchmarking or linking them against MSCI's indexes. And major clients will often require ETF managers like BlackRock to benchmark their performance against MSCI index. So for MSCI, the thesis is an extremely simple one. MSCI asset link fees is like a toll gate business, with increasing asset under management leading to increasing revenue for the company at high margins, of course. The subscription also brings in a stable recurring revenue into the business, with growing subscriptions every single year with low churn rates. So the company has a retention rate of upwards of 90%. That is incredible for any given business. And for MSCI, I expect them to continue this high retention rate in the future as well. So when more assets under management comes in, more licenses need to be paid for more MSCI products, more frequent rebalancing will need to be used as well, which leads to even more data needed from MSCI. They need greater risk models, analytics from MSCI, as well as when your assets under management rise. So the entire thesis is simply just an increase in your assets under management with secular tailwinds behind it as well. So why exactly will your assets under management increase? Number one is just the increasing amounts of liquidity in the market. With more money being put into the market, more assets under management will be linked to all your MSCI ETFs. And there's a shift from active investing to passive investing as well. So we're seeing that shift currently. It has been a secular tailwind for the company. So if this trend continues, then MSCI will definitely benefit from it. I'll be skipping over the analytics business as well as the ESG business. I think the main core moat for this business is simply just in the indexes. The analytics portion leverages on the index portion to basically generate revenue, because a lot of its clients from this analytics portion actually come from those that use their indexes. So similar for ESG as well, it is an entire ecosystem of MSCI products that they're trying to sell. And the main thesis is simply just the assets under management and the MSCI indexes. So these are a few of MSCI's moat. Number one is just your brand name and your network effects. So MSCI indexes are the standard language for global equity exposure, particularly in non-US and emerging markets. As more ETFs track MSCI indexes, additional fund managers and institutions will have to link their ETFs to MSCI indexes to maintain consistency and benchmarking, which will further strengthen MSCI's dominance through network effects. So that's one portion of the moat. So besides that, there's high switching costs as well, because your asset managers, they use MSCI indexes to build ETFs, to build risk models and systems. It reduces regulatory friction when your ETFs are linked to MSCI products, and it is also easier for them to benchmark their performance against MSCI index ETFs. As their CEO mentioned previously, the trouble required to switch outweighs the cost-saving efforts. Switching away from MSCI indexes will introduce regulatory friction, disruptions in operations, and investor confusion. And that is one of the key moats for MSCI. And besides that, they also have intellectual property. So data is gold, and MSCI owns a lot of it in this industry. They build their own proprietary ESG rating systems. They have their own risk formulas. Similar to what FICO does with their FICO score, it licenses, sources, cleans, structures, and models proprietary data at scale, something that cannot be replicable by any other companies. And that's why I'm extremely bullish on MSCI. And if you have to look at the growth of the company is still growing EPS at around 15%, despite being so mature already. So for this company at its current valuation today, one of its historical low valuations, I think the company is providing a decent opportunity to enter right now. The next stock that is an interesting buy right now, an incredible buy in fact, is ASML. So ASML year to date is up around 3%. It is currently trading at a 24 times earnings. So for ASML, their premium has basically disappeared. So historically, the company has always traded at a premium to all these different other semiconductor companies. So for ASML, it is currently trading at a 24 times earnings. And you have companies like TSM trading at 25 times earnings. You have AMAT trading at 23 times earnings. And you have Lam Research, which is trading at 27 times earnings. So as compared to all your different other wafer fab equipment sections, like AMAT as well as Lam Research, ASML is currently trading at a discount to them or on par with them. But for ASML, it is a much higher quality business than all these other businesses here. So this could be a good buying opportunity if you're looking to start a position in ASML. So ASML, according to their 2030 guidance, is still on track to have around 11% revenue growth. And if you're to couple that with their margin expansion, so their margins are going to go from around 50% to around 56 to 60%. So when you see margin expansion as well as revenue increasing, the company could easily get around 15% net income growth from this year all the way until 2030. So for ASML, it is probably one of the highest quality businesses out there. So you have intellectual property with that EUV lithography technology. It has high barriers to entry because it costs billions and billions of dollars for any given company to try and design and model after ASML's EUV machines. They have network effects as well. And for this company, it has high switching costs. So imagine your fab, it is built for ASML machines, and suddenly you have to change it to another machine. It will not only cost you millions and millions of dollars for you to tear out the current ASML machines, you will also have to structure the entire fab to suit the other machine that is coming in. So a lot of your fabs right now, they're built for ASML machines, and that's why it is extremely high switching costs for any company that is trying to switch away from ASML, if there's an alternative, of course. And besides that, the company is operating at massive scale, and that's why companies like Nikon, like Canon, they cannot compete with ASML. Lastly, the company has a recurring revenue segment that is increasingly growing. So the company has your installed base portion, which is currently around 25% of their total revenue. I expect that portion to continually grow, and as the company continually grows that segment, the company will become more and more predictable because it is less reliant on new buys of their machines. So for ASML today, I view it as one of the highest quality businesses out there, and it is currently trading at a discount to its intrinsic value. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, what do you think about Adobe? Is it good prices to start investing? So for Adobe, it is a company that is fundamentally great. I think the numbers look great. It is probably one of the highest quality businesses in terms of its fundamentals. But the problem is, with Gen AI continually growing, Adobe's business could easily be eroded over the next few years. In fact, over the next 5-10 years or so. So for Adobe, I'm not extremely confident on this one. Of course, if the stock drops to an unreasonably cheap valuation, then it will look extremely interesting for a short-term buy. But over the long term, what you want to do is you want to buy high-quality businesses, high-quality compounding machines, not a company that is facing existential threats. Next question, it says, what do you think about Fiserv? So for Fiserv, I think the fundamentals look great. The company has grown EPS by around 10% over the past 10-20 years. And overall, if you have to look at the fundamentals, I don't think there's a flaw with it, apart from the debt of the company. So the company actually raised a lot of debt to buy this other company, which is Clover, which is operating all these different POS systems. And this is the highest growing segment of the entire business. For Fiserv, the business is extremely complicated. I don't think a retail investor will be able to understand completely what they do. So for Fiserv, although it is currently trading at a decent valuation, I would say, I would avoid this one, simply because the business is a bit too complicated for anyone to understand it. I hope you guys have found this one useful and invest safe.